Good morning, ladies and gentlemen, and welcome to the Global Smaller Companies Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it is appropriate to do so. Before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. I would now like to hand you over to Lead Portfolio Manager, Nish Patel. Nish, good morning, sir.
Good morning, Jake, and thank you for hosting me today. And good morning to all of our webinar participants today. So if we go through our agenda for today's call, what I'd like to do really is, first of all, provide you with a very quick overview of the Global Smaller Companies Trust. And this is mostly for the newcomers to this trust who haven't heard the story before. Talk a bit about the market environment over the last 6 months. Go through the interim results for the 6 months ended 31st of October. We'll talk about the performance track record over the short term and the long term, what we've been doing on the portfolio and how we're positioned, and what we think the outlook is. So let's start with an overview of the Global Smaller Companies Trust. So the overarching aim of this trust is to provide one vehicle that gives investors access to what we think are the very best smaller company opportunities in developed markets, as well as the faster growing emerging markets. The philosophy is very simple. We take a long-term conservative approach to investing in good quality growing businesses. We do this in an opportunistic way. We're looking to buy into these companies when they are available at a significant discount to what we think they are intrinsically worth. The trust has a track record of managing its discount, an active approach to managing its discount. And more recently, this has been through buying back its own shares. So in the last 6 months, for example, we have bought just over 5% of the company back because the discount has been wider than our 5% target in normal market conditions. We have been active on the buyback, and that is something that we look to do going forward. Performance over the long term has been strong in absolute and relative terms, and we're really proud to have raised our dividend for 54 years consecutively. So this page shows you what we typically invest in. And what we're trying to do is invest in companies that have got very strong competitive advantages. And importantly, those advantages are sustainable. These businesses generate lots of cash flow. They have good balance sheets. They operate in industries that have barriers to entry. And they are very diversified by customer and product. They're run by very capable operators and by management teams that have a strong track record in capital allocation. We're looking to buy into these companies opportunistically. We buy into them when the shares are trading at what we think are a discount to what the company is intrinsically worth. And we do use a whole host of different metrics to come to our valuation. The philosophy and process does show up in the numbers. This is data as of the end of October. And you can see that the median data suggests that the companies that we invest in tend to have superior quality metrics, such as gross margin, operating margin, return on equity, and leverage. And at the same time, it is at more attractive valuations than the benchmark, with a lower multiple of sales, lower multiple of earnings, and a higher dividend yield. So let's talk a bit about the last 6 months and paint a picture of what the market environment looked like. So the major economies were still on course for a soft landing. We think that a key part of that was a very resilient labour market. it's true that the services sector was particularly robust, but we did see weakness in the manufacturing arena, but that seems to be stabilizing. Inflation came down significantly over the 6-month period, and it's come down to levels that, although they are slightly higher than the central bank targets, they have come down to levels that where central banks do find them acceptable, and they have started to cut interest rates. Geopolitics has been an issue for a number of years now, and this 6-month period was no exception to that. We did obviously have a lot of news flow related to the US election, and there were a lot of concerns whether we would actually have a clear result in the US election, but thankfully we did. Similarly, in the UK, there was a very decisive election result, but what has become more evident recently has been that the growth agenda that was promised by the new government is facing significant budgetary challenges. Many of the trends that we did notice over the last certainly year and a half or so still were in place within this 6-month period. So, for example, smaller companies continue to lag larger companies. That has been ongoing for a number of years now, actually. North America continued to lead. Latin America was a particular area of weakness, and the technology sector was particularly strong. Energy did lag in the 6-month period. Corporate earnings were generally quite solid for the 6 months ended October, but we did see significant expansion in valuations, especially in North America and especially in larger companies. Turning to the financial highlights for the 6 months, it was a difficult 6-month period, especially in the UK. We do have significant exposure to the alternative investment market, the AIM market, as it's known, and that was especially weak ahead of the UK budget because of concerns over changes in the treatment of AIM shares from an inheritance tax perspective. We did see selling in that particular asset class, and that did hurt the portfolio in the UK. In addition to that, we did see some stock-specific challenges, and I will go into some more detail on those. In North America, we had good stock selection in the industrial sector and in the energy sector, but that was offset by adverse stock selection in technology and financials. Europe was ahead of its local benchmark, and in Japan, our internal portfolio had a very strong 6 months. However, this was partially offset by the external portfolio, which had adverse stock selection in the telecom sector. We have now actually sold that external portfolio, so Japan is completely internalized now. In the rest of the world region, the portfolio was behind the Asian markets, but it was ahead of its Latin American markets. And we did see the discount widen with the whole investment trust sector over the 6-month period. But we did use the discount widening as an opportunity to buy back shares. We were very active on the buyback over the 6 months. The dividend has been raised again, continuing our record, and this is testament to the companies that we invest in. They are highly cash generative businesses, and it did allow us to raise the dividend again. Looking at attribution for the 6 months ended October, I won't go into all the individual stocks here, but I will try and highlight some themes from what we saw in the portfolios. So the defense sector produced good results for Curtiss-Wright, which is a large holding in North America. This is a producer of defense electronics, as well as other components for a number of different end markets, including nuclear. In addition to Curtiss-Wright, Kinetic in the UK also benefited from a very strong spending environment on defense related areas. Brown & Brown is a company that we've held for a number of years now. This is an insurance broker in the US that specializes in small and medium-sized accounts. Insurance rates are generally climbing, and that is helpful for Brown & Brown, and the company is also benefiting from very good retention amongst its customer base. In the UK, we do own a position in Baltic Classified, which is an online classifieds portal in the Baltic states in Europe, and they delivered good results. The UK market is attractive from a valuation perspective, and we are seeing takeover bids in the UK. And pleasingly, we did have a takeover bid for Essential, which was bid for by Informa at a 53% premium. In Europe, our position in Acceleron Holdings has been built up over the last 18 months or so, and the company is delivering. It had very strong organic revenue growth, particularly in its marine and energy businesses. CTS Eventim is a German ticketing business, and they were involved with the Paris Olympic Games, and they also managed to secure some contracts for music events in the coming year, and the shares have responded to that. In Japan, we have benefited from the very well documented program to improve Japanese corporate governance and capital allocation. So, for example, Sanwa Holdings, which is a building products producer, they have changed their capital allocation policy to make it more shareholder friendly, and the company has seen a re-rating in its shares. SWCC Showa Holdings is a wire and cable manufacturer, and in Japan there has been significant infrastructure related spending, particularly in the power segment, and the company has seen improved fundamentals because of that. On the negative attribution side, CDW is a value-added reseller of technology products in the US predominantly, and the company did see a slowdown in spending by its larger customers. We were hurt by higher labor costs in some of our businesses in the US, and that was especially true for US physical therapy. And the oil price fell, and that did hit some of our holdings more broadly. For example, Cosmos Energy and WEX, as well as Ashtead Technology, they all fell because of a lower oil price in the period. In the UK, Next 15 was our largest casualty. This is a marketing business, and what they saw was a slowdown in their technology and government-related verticals, and they also lost a contract that was supported by a large client. Kitwave Group, which has done extremely well over the last couple of years, was impacted by adverse weather, and the company is also spending on growth initiatives, which has temporarily dented its profitability. In Europe, it's been really well documented that the auto sector has been under pressure, especially because of the arrival of lower priced imports from China and lower subsidies in general. And Stabilus was not immune to that. That company produces components that goes into autos, and the shares were hit along with the wider sector. Tecan Group is a producer of laboratory automation equipment in the biotech area. That company, along with David Campari Milano, which is a spirits producer, both of those businesses were hurt by weakness in China. And then in Japan, the anticipated rate increase by the Bank of Japan did lead to some profit taking, particularly in the financials area, and that hit the shares of Nishi Nippon and Nomura Real Estate. So looking at performance over the last year or the last 12 months, it has been a difficult period for active managers. Momentum has been a driving factor behind returns, and quality and value in tandem has not really worked especially well over the last 12 months or so. So we have had to battle that headwind. Versus the peer group, however, this trust is still in a good standing. It is ahead of all of its peers over 3 years. Over the last 12 months or so, the trust is behind its benchmark by 2.6%. The share price is ahead of its benchmark, however, because the discount has narrowed. So the buyback that we have implemented, or the increased buyback program that we have implemented, does seem to be working, and we are seeing some results from that. This is very much a long-term strategy, and we think that investors should focus on the long term. And the long-term performance data is strong, with the Global Smaller Companies Trust growing its share price over 9-fold over the last 25 years, which is well in excess of its smaller company benchmarks, as well as the MSCI World as well. So what have we been doing to the portfolio? So our main activity has been focused in 3 different areas. The first area I'd like to talk about is what we think are quality businesses that can grow reliably, whatever happens to the economy and markets. And the reason these businesses can grow reliably are that they are either backed by secular trends, or they just have very stable end markets, or they have a high degree of recurring revenues. So, for example, in Switzerland, we have added to our position in SIG Group. This is a packaging business with its main focus on the food and beverage vertical, which is very stable in itself. And growth can come for this company through the ongoing trend of sustainability. Shark Ninja is a company that many of you may be familiar with. It has got a very strong brand in the home appliances segment of consumer products. The company has a very good business model in terms of lowering its costs and producing highly innovative products at very low cost, especially when you compare it to a competitor such as Dyson. And the company can continue to grow from the introduction of new products and by taking its existing products into new markets. Intercos is based in Italy, and this is a producer of cosmetics for its partners. It is an outsourced model, so its partners will go to Intercos to develop particular cosmetics, and the company has a very strong track record of innovation, and it uses its scale advantages to produce these highly innovative products at very low cost for its clients. We did add to our bank holdings in the US in the period, and the 2 banks that we added to, United Bank shares and Prosperity Bank, have very strong underwriting records through an economic cycle with very low levels of loan losses. And we were able to buy into those companies at an attractive valuation. We think that they can continue to grow over the long term because they are in very favorable geographies within the US. So United Bank shares is based in Washington, D.C. and its suburbs, which are very affluent areas within America. And Prosperity Bank is based in Texas, which is seeing a lot of companies move into the state because of low levels of tax and a growing population. We also invested in some cyclicals within the period. Now, these are businesses that are very depressed in terms of the end markets are very depressed, but the valuations are extremely low, and that provides very good downside protection. And the 2 areas or the 2 segments where we have been more active in cyclicals are in anything related to real estate and housing, and in industrials and semiconductors within the or semiconductor businesses with strong presence in the industrial end markets. So, for example, we did add to our position in Front Door, which is a US seller of home warranty plans. The company's revenues are very correlated with the purchases of new homes, and currently the purchases of new homes in the US is at quite low levels because of high mortgage rates, but we think that as mortgage rates come down, that business should improve for Front Door. Bodycote is a UK industrial business. Its revenues are tied to global industrial production. The company is involved with heat treatment services, where it is looking to strengthen metal structures. For example, Rolls-Royce will send its aircraft engine blades to body coat to be heat treated so that they can be resistant to very harsh environments. And we think that as industrial production, which has been at quite low levels for a number of years now because of the ongoing destocking trend, as that comes back, that Bodycote should see an improvement in its earnings profile. And Marshalls is a UK business that is involved in landscaping products. So, for example, patios. There was a significant amount of buying of these sorts of products during the COVID period, and the company has seen a slowdown in growth. But we do think that the housing stock in the UK is particularly aged and it does need upgrading. And the UK is spending money on infrastructure, and that should help Marshalls see a recovery in its earnings. And the last area where we have been active is in commodity-related businesses. And Vitesse Energy is a oil company that is based in the Williston Basin in the US. It takes a lower risk approach to oil exploration because it has a non-operated model where it is actually collecting royalties from its partners as they do drill for new assets within the basins that they operate in. Turning to sales within the 6 months. So there were some instances where the investment thesis did break for some of our companies. There were two cyclical businesses where we think the recovery has been pushed out and may not happen in the medium term. And those were World Connect, which is a distributor of fuel, and American Vanguard, which is a producer of crop protection chemicals. We think the recovery for both of those companies has been delayed and is beyond our investable timeframe, so we have sold out of those. Rémy Cointreau is a spirits producer that is producing, it is a French company that produces spirits, and the company has significant exposure to China, and the growth has slowed down from its Chinese end market, because the economy is sluggish in China, but also because there have been some trade restrictions being put in place. We did have takeover bids that we monetized. So, for example, Stericycle, which is in the business of collecting medical waste, was bid for by Waste Management at a 30% premium, and Essential received a bid from Informa at a 53% premium. So we did use those the takeovers as a way to raise some cash, and we did take some money off the table in some businesses that re-rated or did reach our price targets, such as Ziggup, Clarkson, Azimut, and Gerresheimer. As a result of the activity over the 6 months, this is our positioning as of the end of October. So you can see that we do have an overweight position in Europe as of the end of October, but since then we have taken some money out of Europe because of the changed outlook for many European countries who may now be faced with tariffs from the US. And in addition to that, political uncertainty has impacted the growth profile of many countries within the Eurozone now. In the UK, we do have a neutral weighting. That has come down as we've monetized some of our bids. And in North America, our underweight position has actually decreased. We have found some good ideas within North America since the year end in April, and we've invested in those. So our underweight position in North America has decreased, and the growth prospects have actually improved a bit in North America. So we think it's right to have less of an underweight there, although we do appreciate that the valuations do look quite high in North America. On a sector perspective, our weighting in industrials has grown, and that's through additions to companies such as Bodycote, MSC Industrial Direct, and Acceleron. In the financials sector, our weighting has increased there as well as we've added to our banks, particularly in the US. These are our collectives as of the end of October. Now, the table here shows that we have just under 19% in collectives, but actually we have just sold our eSpring fund, which is 5% of 18.9. So we are now just under 14% in collectives for this trust overall, and that is significantly lower than it has been in previous years. So this is very much, and one should think, all clients should think of this as predominantly a stock picking fund with most of its assets in individual stocks rather than collective funds. We only use collectives for the emerging markets, and it is less than 14% of the overall trust. We think the internalization made a lot of sense because it does give our clients access to a very strong Japanese equities team within Columbia Threadneedle, and it does lower our overall costs for our clients. So we thought it was a sensible thing to do. Turning to the outlook, and I'll give you the usual caveats that this is very difficult to predict, especially in today's environment, but I will give you what I think is the prognosis perhaps for the certainly for the short to medium term. We think that the market environment will remain volatile. It will be very sensitive to the outlook for interest rates, which is driven by the outlook for economic growth and inflation, and geopolitics will certainly have an impact. In an environment where growth is moderate, we are seeing inflation come down, and central banks are starting to cut interest rates, and there might be potential deregulation on the horizon with the new administration in the US. That is generally a good environment for risk assets. The US administration that has come in now, that administration can lead to a wide range of different policy changes, but the key will be in the detail, in what's announced and the quantum of what's been announced, and in what order those policy announcements take place, and we will be watching that very carefully. Growth outside of the US has been very sluggish. We would expect next year to be slightly better than this year, but clearly any tariffs that are imposed are potentially a risk to countries outside of the US. It is very possible that we do see a resurgence in inflation because many of the things that have been talked about by the new administration in America do have the potential to increase inflation. So we are wary of that. We are leaning towards companies that have pricing power and that have an ability to put through cost increases to their customers with very low impact on volumes. Fiscal deficits have been talked about for a very long time. We are starting to see some impact from the bond market in terms of the level of fiscal deficits in certain countries. So that is something to watch, particularly over the coming months. And the market participants in general, I would say, if you look at the valuations across the world, particularly in the US, valuations do look high. So we think there is some complacency setting in certain markets. And we want to be very wary of that. We want to be able to navigate that environment by focusing on the more attractive parts of the world's stock markets and sectors. And at this point in time, where the environment is uncertain, there are plenty of cross currents. We do have a preference for companies that will grow regardless of what happens to the economy and markets. And I have given you some examples of some of the companies that we've invested in that do fit that mantra. So that's the end of my pre-prepared remarks. I would be very happy to take any questions that you have, and I think Peter is going to moderate those for us.
Yes, I will. Thank you, Nish, for that. That was very insightful. Could I please encourage questions to be asked in the chat function, and I'll get round to as many as possible. Nish, we've started off a little bit with valuations. Obviously, it's been a key for a couple of years, certainly in the small cap arena. The question is, do you see lower valuations in the UK and Europe as an opportunity versus the increased exposure in the US? And what would be the catalyst for a rotation in your view?
So we do have a sizable weighting in the UK. We are equal weighted from our benchmark perspective, but we do have 20% of this trust invested in UK assets. And many of the UK businesses that we've invested in are actually quite international in nature. So they do derive a lot of their revenues from outside of the UK. The UK market, to us, doesn't seem undervalued. It has suffered from political uncertainty certainly since 2016. There has been a significant amount of outflows from the UK market, and it doesn't have many of the sectors that have been in vogue, such as technology. It is underrepresented in those sectors. So we think the market is very unloved in the UK, and that is producing good opportunities for us. So we're happy to have a sizable weight in the UK. In Europe, the outlook is not particularly rosy at the moment. There is a lot of political uncertainty. There is a lot of impact from a slowdown in China. But we think that the valuations have corrected significantly in Europe, and that is producing some opportunities. So we do have a slight overweight position as of today in Europe as well. But that has come down over the last month or so. In the US, it's clear that the growth prospects are better than other parts of the world. The US businesses, the US has always been a home for entrepreneurship, and it has created some of the very best companies in the world. It is also energy independent, and it has a large population to sell into. So the US has been a growth engine for several years now, and rightly so. But we think the valuations are looking quite rich in the US. So we are picking our spots within the US, and we are still finding good ideas, and that's the main thing.
And if we stick on the US for the moment, obviously we had a big election there in November. The uncertainty was taken out of the market, but what are the risks, or equally, what are the tailwinds that could come in the US smaller companies after the Trump win?
Yeah. So it's reassuring that we did have a decisive result in the US, because I think a lot of people were worried that we may not even have a clear result, and that we may even have a contested election. But that didn't come to pass. We saw strong support for the Republican Party and for Donald Trump across the demographic. And he also won the popular vote as well. So he has a clear mandate. Now, what does it mean? So the Republican Party have talked about deregulation. So that can be helpful for certain sectors, such as financials, especially banks. The energy sector can benefit from deregulation. And small business in general is helped by deregulation. Tariffs have also been a big talking point. And tariffs are, one would think that would be hurtful to the rest of the world, but may actually help some more domestically focused US businesses. Although it will be interesting to see what the reaction is by countries that have tariffs imposed on them, and whether exchange rates might actually adjust to neutralize some of the impact from the tariffs. The tax cuts that were announced in 2017 are likely to be extended. So that is good for corporate profitability. There has been talk about further tax cuts in the US, but we think that is possibly unlikely, because the level of funding that would require may create strains on already wide budget deficit. And then, when we think about other policies, immigration has been the standout policy as well of the Trump administration, which could be potentially risky, because the labor market in the US is already quite tight. If we do have harsher immigration policies, or more stringent immigration policies, then that won't help that situation, and we could see companies see labor costs go up. So there are plenty of cross currents. We think this portfolio that we have in the US is really well positioned. We're not like a lot of US portfolios in the sense that we are more diversified rather than having the bulk of our assets in the healthcare and technology sectors. We do have representation in a lot of the beneficiaries of the new administration, such as in construction materials and in industrials, for example.
Lovely. Question about the buybacks. We have been active. You have been active with buybacks. How do you balance investing for growth against the discount control policy?
So we do look at both of these things, and at the moment we think that this trust is actually trading on a double discount, if you like, because the companies that we have invested in, which we think are have very strong growth prospects going forward, they are actually intrinsically undervalued themselves, and the trust is also undervalued. So in effect, by buying back our shares, we're trying to take advantage of the two levels of discount that are currently in place, and that's why we are preferring buybacks at the moment. We're not seeing so many growth opportunities in the world markets to only warrant just investing in individual stocks.
Question on the team and the universe. With a large universe, how do you balance sector and geographical exposure, and do you meet all the companies you invest in?
So it is a large team. There are 9 of us involved within the management team of this trust. We do see a lot of companies. Seeing companies is really important, especially being in small cap, because you do need to understand the business models fully. You need to meet the management teams, because the management teams are key to the shareholder value creation over time. So that is something that we do pay a lot of attention to. We also think about the capital allocation policies as well. So capital allocation is a key way of driving shareholder value creation over the longer term, and understanding that fully does require a meeting with the management team.
Typically, what free cash flow yields are you seeing or aiming for in the portfolio / investable universe by region?
That is a difficult question to ask, because it does vary within the types of investments that we're making. And free cash flow, when we think about free cash flow, I think we have to use maintenance capex rather than total capex, which includes the growth element as well. And some businesses are more cash flow generative than others. So banks, for example, we don't really invest in them using a free cash flow valuation metric. We're looking at tangible book value. But what we're doing when we value a business is we're looking at a whole host of different metrics. We're looking at multiples of earnings, multiples of EBITDA, cash flow, discounted cash flow, if we can make few assumptions when coming up with projections of future cash flows. We're looking at a whole host of different metrics, and then we want the shares to be undervalued when you take an average of all of the metrics that we're using.
And a question about the UK. Does the liquidity in the UK smaller companies sector concern you? Do you view this as a risk or opportunity?
I don't think it's a secret that the UK smaller companies market is very out of favour at the moment. It has had significant outflows. We are conscious of liquidity at all times. When we do start a position in a new company, we do judge what the liquidity is like and whether we will be able to get out of the company in an orderly fashion if something goes wrong. So it's something that we pay a lot of attention to. Liquidity does present opportunities as well every now and then because of forced selling or just outflows by a holder. It does create opportunities to buy into some really good companies at attractive valuation. So it's something that we pay a lot of attention to, but we do try and stay on the right side of it.
Great. Well, we've just come up to 40 minutes, so I think we'll call a halt there. If you can just give some closing comments on the trust, a summary of where we are, and then we'll hand back to Jake.
Yeah. Well, first of all, I'd like to thank all of you for your participation today. We do look forward to briefing you again in the new year, and I'd like to take this opportunity really to wish you all a very Merry Christmas and all the best for the coming year.
Perfect. Nish, Peter, if I may just jump back in there, and thank you very much indeed for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the Global Smaller Companies Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.